Hello everyone, welcome to our research presentation and market outlook for the month of April 2022. The presentation contains the update on global markets, domestic markets and fixed income markets along with our outlook. On the global market front, global equity indices were volatile and ended the month on a mixed note. Increased uncertainty about global economic growth due to escalating conflict between Russia and Ukraine and various sanctions imposed on Russia by the US and other countries led to risk of sentiment amongst investors. Value buying at a lower level and positive news flows around peace talk between Russia and Ukraine supported investor sentiments to some extent. On the liquidity front, central bank of some large economies including US and UK have increased interest rates following steady economic growth and higher inflation. European Union also accelerated plans for tapering of liquidity support to deal with higher inflation. Apart from hike in policy rates, market would be tracking the pace of liquidity tapering, which is likely to have direct impact on global liquidity condition and equity valuations. On the global macro data front, developed economies witnessed a steady trend as manufacturing PMI and employment reading indicated improvement in economic activities over the past few months as the economies opens up and fear of COVID-19 recedes. Various multilateral agencies have downgraded their global growth forecast for CY22, citing higher inflation and resultant action by central banks to control inflation. On the commodity front, commodity prices continue to move up on the back of steady demand condition and supply side disruption due to conflict between Russia and Ukraine and new mobility restrictions in China. Going forward, higher commodity prices are likely to keep upward pressure on global inflation. Global uncertainty and rising FPI outflows impacted the emerging equity market and currency performance. Indian equity markets ended a highly volatile month on a positive note on expectations of a progress in peace talk between Russia and Ukraine. Buying by domestic institutional investors at a lower level and positive flows towards the end of the month supported the recovery in equity markets in March 2022. Meanwhile, government policies continue to remain supportive for structural economic growth. Private sector capex, which has been down for past few years, have shown some promise lately with rollout of PLI schemes and improving capacity utilization of manufacturing sectors driven by higher exports. On the demand front, while the rural demand has been weak, it is expected to revive in the coming months on the back of higher agricultural output, better agricultural produce price due to global supply side constraints, expectations of a better monsoon and government's supportive policy for rural India, whereas urban demand showing a reasonable strength. On the macro data front, high frequency indicators like GST collection, bank credit growth, forex reserves, amongst others, have witnessed improvement. Meanwhile, recent sharp upmove in the crude oil price is a key cause of concern as rise in crude oil price by $1 increases India's import bill by close to $1.43 billion, leading to higher current account deficit. Over the past 2 years, a very important phenomena has been taking place. Due to better commodity prices, very strong equity market and high equity capital raising and cost savings by Indian corporates, we have witnessed strong deleveraging by corporate India. That along with rising household savings and reduced NPAs in banking system have created a strong position for these entities to absorb any downside and to support any upside momentum as we move forward. And this could lead to recovery in capex cycle and consumption demand and support overall economic growth in the country. Corporate earnings for Q4 FY22 are likely to be muted on the back of increased margin pressure, while the top line growth of Indian corporates remain the key. Going forward, government's focus on infrastructure development and job creation is likely to drive capex demand and thereby push consumption demand as well in the medium term, which would be positive for corporate earnings. On the back of higher inflation and liquidity tapering, most of the multilateral agencies expect India's GDP growth between 8.7% to 9.5% YoY for FY22. On the valuation front, S&P BSE Sensex is trading at 24.5 times of FY22 estimated Bloomberg consensus EPS of Rs 2400 and at 22.1 times of FY23 Bloomberg consensus EPS of Rs 2650. The equity market valuations have continued to remain rich based on a trailing PE as well as on the market cap to GDP multiples. Hence, any sharp dips in equity market could be used as buying opportunities by investors with a 2 to 3 years investment horizon. The key risk to equity market could be following. Ongoing geopolitical tension between Russia and Ukraine may have adverse impact on global trade and economic growth. Rise in volatility in commodity prices could put pressure on global financial market. Sharp volatility in US bond yield may lead to rise in risk of sentiments. Delay in PSU asset monetization plan may lead to higher fiscal deficit in the near term. Any delay in implementation of a key reform may delay the structural recovery in growth. On the equity mutual fund investment strategy front, going forward, stable demand and rising capex could keep the earnings expectations stable, though high interest rates could limit the PE re-rating. Also, with current valuation remaining rich from a historical perspective, equity market could move in a range bound in the medium term, and return expectations from the market needs to be lower relative to what we have seen in last 6 to 7 quarters. Hence, we continue to maintain an investment deployment strategy of 50% lump sum and rest 50% to be staggered over the next 3 to 4 months. Investors could focus on large cap, large and mid cap, value funds, hybrid equity funds and infrastructure funds with the horizon of 2 to 3 years in line with their risk profile and product suitability. That is all on update on equity market. Now we shall move to the fixed income segment.
On fixed income markets, domestic G-Secs remained volatile and closed on a negative note in March 2022, wherein yield on the 10-year benchmark G-Sec closed higher at 6.84% on 31st March as against 6.77% as on 28th Feb. G-Sec yields rose on account of caution due to conflict between Russia and Ukraine, caution in the run-up to the monetary policy of the US Federal Reserve, and the release of the government's borrowing calendar for the first half of FY23. The government decided to front-load the borrowing in the first half of FY23 at about 60% of the total estimated borrowing for the year. With the borrowing program being front-loaded, markets would be faced with a fresh heavy supply of G-Secs going forward, which is likely to put upward pressure on bond yields. With the limited scope for the RBI to do OMOs, given the high liquidity surplus, the RBI may have to use tools such as special open market operations involving simultaneous buying and selling of government securities. The US Federal Reserve raised its key policy rates in the monetary policy by 25 basis points in line with expectations. The Fed hinted towards its balance sheet reduction, which could begin in the near term. Expectations of a rate hike in every subsequent meeting in calendar year 2022 are also building up now. The US Fed accelerating its monetary policy tightening process may give way to the faster monetary policy tightening by other major developed nations as well. In such a scenario, the currencies and the bond yields of emerging markets including India may witness pressure. The consumer price index based inflation for India in Feb 2022 rose and came in at 6.07% year-on-year as against 6.01% year-on-year in January. Going forward, CPI inflation may rise further from here and may remain above the RBI's flexible inflation target of 2 to 6%. Recently, crude oil prices have risen sharply and that is likely to push headline CPI inflation higher. Additionally, possible disruption in supply chains and shortages of materials on account of the current geopolitical tensions along with an unfavorable base effect are also likely to put an upward pressure on CPI inflation. India's current account deficit increased further in the third quarter of FY22 and stood at $23 billion, which is about 2.7% of the GDP. On the other hand, the domestic forex reserve stood at $619.67 billion as on 18th March 2022. If we consider the imports data for February 2022 and the levels of forex reserves, India has an import cover of approximately 11 months. Thus, while strong forex reserves provide comfort, the trajectory of current account balance will be a key monitorable going forward. Domestic banking system liquidity surplus declined during the month of March, wherein liquidity surplus as measured by the RBI's net liquidity adjustment facility stood at a daily average of rupees 6.41 trillion in March as compared to 6.8 trillion rupees in February. With RBI's assurance on keeping adequate liquidity in the system to support the economy, the current high liquidity surplus is likely to remain for longer. However, active liquidity management is likely to continue to ensure that the RBI has room to undertake supportive measures. The yield curve remained steep during the month of March and is likely to continue remaining steep, sustained by RBI's assurance of maintaining adequate liquidity in the system to ensure support to economic growth, preventing the shorter end from rising meaningfully. At the same time, the large G-Sec supply and global factors are likely to keep the longer end elevated. The up to 8 years segment on the yield curve provides opportunities of attractive term spreads across tenors. In terms of the fixed income mutual fund investment strategy, going forward, bond markets are likely to be characterized by volatility, tracking global geopolitical tensions, monetary policy normalization by the major global central banks, higher supply of government securities domestically, inflation trajectory, as well as movement in commodity prices. In a scenario of expected volatility, investors should continue to look at options that are likely to have relatively higher stability and flexibility to take advantage of the reversal in the monetary policy through funds that are largely maintaining shorter portfolio duration and have higher exposure to better credit quality debt securities. One can also look at closed-ended strategies that give visibility of performance and do not get impacted by volatility. Also, given the current steep yield curve, fixed income strategies with superior credit quality portfolios that provide visibility of performance and allow locking in current attractive term spreads through target maturity funds can also be looked at. Thus, in terms of the fixed income mutual fund investment strategy, in light of the expected volatility, currently investors with an investment horizon of 12 months and above can look at short duration funds and corporate bond funds. Investors who would like to lock in current available yields and are not comfortable with volatility can look at relatively longer tenor fixed maturity plans. Those investors who have relatively longer investment horizon could look at target maturity index funds that invest in PSU bonds and STLs, with funds having maturities between the years 2025, 2026 and 2027. For an investment horizon of 3 months and above, arbitrage funds can be considered, whereas for a horizon of up to 3 months, investors can continue to look at overnight funds and liquid funds. Investors should invest in line with their risk profile and product suitability. That is all from the research presentation for April. Thank you everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.